Coming up today, what's next for the S&P 500? Amazon rallies to 2 trillion, the latest from Nvidia. Home sales fall sharply. Inflation in Australia comes in hot. FedEx rips higher. And why now Julian Assange is a free man. Good evening, good morning, good afternoon, wherever you may be joining me from around the world today. Thanks very much for tuning in to the Click Capital Daily Market Review. My name's Jared, and I'm going to get you all up to scratch. The latest developments across financial markets and more. As we make our way through this week towards PCE data this Friday, volatility is coiling up in the main indices, and a bit of a continuation from what we saw yesterday, with that strength in mega-cap tech versus the rest of the market continuing a bit further. And we're back to soft market breadth out there overall. Looking at volume breadth, bit of a sharp turn down, and short-term breadth above the 20-day average. And once again, stocks making new lows, outpacing new highs. Volatility market's still really tame though. Got the VIX under 13. Volatility risk premium just kind of sitting there under 5 points. And look at that, bond yields just calling up as well. We could get a big move this Friday after PCE if it comes in a lot hotter or weaker than expected. High yield bonds still just holding up above the 50-day. Monthly high breakout for the dollar there, appreciating further against the yen. And Bitcoin still trying to find support just above $60,000 a level here. And crude oil stalling out just above $80 a barrel as well. Looking at the biggest stocks out there, Apple climbing 2% today on weak volume. There's Nvidia just slightly higher highs, higher lows. Amazon having a good day, up 3.9%, breaking out above 2 trillion market cap for the first time, and a nice move up there for Tesla, taking out some monthly highs as well. So the market is still grinding higher here. I can see my trend strength indicator is growing back in the blue, and like I've been saying, when the market goes technically overbought in the short term and doesn't retrace sharply like we saw back here in April, kind of just hovers and consolidates and grinds around that area, that typically bodes well for the medium term. And like we can see from the VIX, the market's just in this drifting, grinding, low volatility kind of regime. And so for the here and now, we shouldn't be expecting any sharp moves. Unlike, however, if we did get a big surprise on PCE, that could uncoil things a bit. And so the S&P 500's up almost 15% year to date. Certainly a stellar return for the first half. Looking back over the last 70 years, the average is 4.72%. However, keep in mind with stock market averages, for example, on average, the stock market goes up about 8% a year. However, most years, even positive, won't be that 8%. Why we get that 8% average and 4.72% first half average is the net result of the outliers. Like we can see these big up years and big down years, that kind of all nets out to an average. But looking back in history, for the first half and the whole year, it's not actually that many years that finish around that average. So in other words, we can either go really above it or below it, and 2024, so far, we're well above the average, and there's still plenty of bullish sentiment out there. Wall Street analysts lifting their year-end price targets left, right, and center to catch up with the market, and that's pretty much what they do. Just chase the market around, rarely going against the grain and taking career risk. And we are hitting some extremes, like the S&P 500 versus the S&P 500 equal-weighted 2-year rolling returns, now approaching overbought levels that have been associated with recessions in the past. And just like the inverted bond yield curve, the SARM rule, a bunch of other indicators, still flashing that a recession is around the corner. However, we have some big opposing forces on that macro backdrop, like passive equity flows, amount of money coming in, passive index funds, ETFs, mutual funds, on track for a record year, expected to eclipse that back in 2021, coming in at over $400 billion, whilst the outflows from active funds over the last decade still expected to be down there, near record lows as well. And I'd say this could be setting up for the biggest and most hidden contrarian trade in financial markets, as the S&P 500 and NASDAQ has absolutely smoked active fund these last 10-15 years. Pretty much the whole world's piled into index funds, which initially started as a niche product back in the early 70s, thanks to John Bogle, who created Vanguard. Back then, the industry was completely dominated by active managers. But as the benchmark has smoked most of the industry, investors have taken notice. And just to be clear, there is a strong case for passive to keep outperforming most of active. However, wouldn't it catch a lot of people off guard if the next 10 years active funds started outperforming passive funds, and that huge trend we've seen over that time out of active into passive might actually top out as well. However, for the here and now, stocks have never peaked in June. Looking all the way back to 1950, stock market's never made its high for the month of June. Still have really good seasonality, especially election year seasonality, and got other signs of market mechanics picking up. See that? And then growing amount of traditional splits. And that is just like what Nvidia did when they did their 10 for 1. They increased the amount of shares on the register tenfold, and the market will reprice them down. And they do that to make it more accessible to small investors, increase the liquidity in the options market. Historically, is a good move for the stock price. And reverse splits is the other way. Typically, by lower priced stocks, companies in trouble, stock price goes underneath $1. Some have listing requirements to keep it above $1, so they'll do a reverse stock split and increase the amount of shares on the register by a certain amount. It could be 5-fold, 10-fold, 20-fold. We just saw Chipotle do a 50-to-1 traditional stock split, as they were previously a $3,000 stock, and so they just did their 50-to-1 today. Now they're trading at $65 a share. Still not really seen it there for the market on IPOs though. Initial public offerings. Companies going from private to public, selling shares to the public, using that capital to grow, or as exit liquidity for the founders and management. We did get a little bit of a breakout for Q2, 77 IPOs, best quarter over the last year. You could say the trend is bottoming out. However, we're still well off those highs from Q1 2021 when we saw over 350 IPOs for that quarter. And what's really hot is momentum stocks, and we can see that in value stocks versus momentum stocks, big valuation gap as well. And with Bitcoin peeling back away from the Nasdaq correlation, some say now if Bitcoin rallies, that'll bode well for small caps. With research from Fundstrat saying looking ahead this year, potential rate cuts from the Fed would likely benefit both crypto and stocks, especially those sensitive to interest rates. And like I've showed you guys, when the Fed cuts, going forward, typically small caps will outperform large caps. But for the here and now, it's still the large cap show led by Nvidia. We just heard from the CEO Jensen Huang at a shareholder meeting addressing rising competition. He didn't call out any competitors directly, but did lay out a clear overall strategy to maintain their position. And I don't think anybody's going to overtake him with GPUs anytime soon. I know China's working like crazy around the clock, and they do have huge leverage, and they potentially could really change things with Taiwan, since Nvidia still heavily relies on Taiwan semiconductor manufacturing for a lot of their fab work. And Jensen Huang, who was actually born in Taiwan and who can regularly be seen in their local food markets on a Friday night. I think it would surprise a lot of people to know a lot of Nvidia GPUs are actually manufactured in Taiwan. Imagine what would happen to the stock price of Nvidia. We woke up one morning, China had invaded Taiwan. That could do a lot of damage to the US semiconductor industry and America at large. A lot of the economy relying on chips now to run. China wanted to use that as maybe a bit of a negotiation tactic or leverage to allow the flow of chips in return for the US not fighting China on taking back Taiwan. Could potentially be how it unfolds. That is all yet to be seen. Moving on, we've got US new home sales falling sharply in May as demand is cooling, with the number plunging 11.3% compared with April. A lot of people locked into low rates, don't want to sell, don't want to move. A lot of millennials still living with their parents, can't afford a new home, can't pay these big rates. And so like a lot of people in the real estate market, praying for a Fed rate cut soon, which we'll get another look at those probabilities in 2 days' time when we get personal consumption expenditures, PCE data. How much has consumers' income and spending gone up in May? With the headline year-over-year price index expected to increase 2.6%. Last read we got was 2.8%. Still rattling financial markets. Japanese yen. Seems the whole market's piling on top of them after the Bank of Japan's last intervention 2 months ago seemingly only bought them some time. Strengthened the yen for about a week or so. Might have to come out, go big or go home. Might see a repeat what George Soros did back in 1992 when the UK economy was really weak. High unemployment and inflation. Pound was getting decimated. Bank of England tried to step in, save it, buy it up, increase interest rates, market kept selling it off, and George Soros and his hedge fund made over $1 billion on that Black Wednesday. And some say the Fed's action could be contributing potentially the same fate for Japan, keeping high interest rates, keeps a really big spread and differential between US rates, bonds, and Japanese rates and bonds, creates a huge carry trade, and now it's a bit of a momentum pile-on, shorting the yen, and they're just kind of pinned in the corner a bit. There's so much debt, really little they can do except just keep on printing and keep on trying to keep things propped up, kind of like a zombie market, which it has been for a few decades now. And a bit below Japan, the bottom of the Pacific, beautiful island known as Australia, also struggling with inflation. Monthly consumer price index rising to 4% in the 12 months to May, up from 3.6% in April, coming in well above expectations. Now got the market pricing about a 50% chance the RBA, Reserve Bank of Australia, will tighten the policy screws at their next board meeting in August. And with inflation now running at 4% and the overnight cash rate at 4.35, not a big margin. Generally speaking, central banks should keep overnight rates at least 1-2% above inflation to try and keep a lid on it. So 4.35 may just be a little too cheap, may need to be actually closer to 5.5, which I'm sure a lot of Aussies with a mortgage don't really want to hear that. Apologies. However, the good news is it's still a long ways off those peaks from 2022. Bad news is it just may have bottomed out and climbing again, just as global central banks been hoping we're all said and done. After Switzerland, ECB and Bank of Canada all cut rates. We also got a hot print from Canada's inflation yesterday as well. Not a good sign at all. But the Eurozone is more justified in cutting rates They just don't have the growth. I'm interested to hear from Europeans watching this show. You're welcome to drop a comment below the video and let me know why you think the Eurozone economy has struggled for the last 15 years. I remember back in the mid-2000s, Eurozone and US economy markets were kind of neck and neck in terms of size and activity and the spotlight. Now the Eurozone's kind of been left behind with not much absolute growth at all in that time, and the US screaming ahead. Definitely mega cap tech is part of that. But why is that? Why is America so much more successful with creating these large technology companies compared to Europe? Why is innovation being stifled in Europe? And I can tell you from a trader and investor, I've invested in stock markets from all around the world, and you'll find a lot of European exchanges impose a financial transaction tax or other expensive fees. I know there's a stamp duty in the UK. Whereas America, the capital flows freely. There's no financial transaction tax. And basically, if you want less of something, just tax it more. And like I said, more tax equals a bigger government, equals a less efficient society. And I can tell you right now, the liquidity across European assets, securities, far lower than America. Much wider bid-ask spreads, in addition to the cost of trading. That's definitely got to hurt the flow and distribution of capital. And that's where I think America really excels, is that capital can easily be raised and distributed into the most efficient areas of the economy, where it'll find the biggest return. And so in my opinion, high taxation and some other socialist-leaning policies, I think, has harmed the Eurozone's growth. But like I said, I'm interested to hear your thoughts on why that may be the case. Moving on to commodities, we've got a bit of weakness here in gold, as we have been seeing signs of inflation pulling back in the States recently, and who knows, maybe we get a surprise to the upside on Friday, just like we've seen in Australia and Canada with inflation. But for the here and now, markets are still pricing in a rate cut for the Fed in September, which should help gold as it competes with investor capital against bond yield, or is gold potentially pricing in higher rate? Technically speaking, we're sitting right at this support zone, just above $2,300 an ounce, kind of similar to Bitcoin, which you could think of as a non-fiat currency as well. That's been consolidating for a few months, just sitting at the bottom of the support zone, while we've got the dollar actually breaking out, strengthening, which is typically a sign of a strengthening US economy, strengthening bond yields, flow of capital. There's not really any real big reason for a flight to safety here just now. And there's a look at TIPS bonds, which are inflation protected treasuries, still in a bit of a range as well. Also got agricultural commodities coming up to a bit of a support zone here as well, been consolidating for a few months, as the world could be barreling towards a food war, according to one commodity trader, as food inflation has already gone up from a growing supply-demand imbalance, and there's kind of been a bit of a pushback and downtrend in globalization in the last couple of years. Since COVID, countries have become much more protective and wanting to become more self-reliant and insulated. That's all inflationary, but we haven't really seen huge inflation in food, more to do with services, insurance, medical care, things like that. We've also got the earth warming. That's going to put pressure on agricultural supplies. More and more clean energy policies, again suffocating the amount of agricultural land. And apparently now Big Macs and Chick-fil-A sandwiches, America's hot new status symbol, has been high income isn't what it used to be. And we've definitely seen inflation and the cost to eat out the last couple of years. That has gone up heaps, an average between 30-40% from pre-pandemic. But what's just breaking out to new all-time highs above pre-pandemic levels, amount of people traveling through US airports, TSA checkpoint numbers breaking out above 2019 highs, which is a pretty good sign of some sort of discretionary spend in the consumer. Moving on, we've got Rivian stock soaring 37% today after it struck a $5 billion deal with Volkswagen. The companies will form a joint venture to develop next-gen vehicle software and electrical architecture. And this is seen as a bit of a lifeline for Rivian, which even though it's been around since 2009, is yet to turn a profit. Only so much runway a company has. And Volkswagen looks to have definitely saved them. Stock finishing up over 23% today. Also having a really good day, one of the most important transport stocks, FedEx, scoring an upgrade, strong earnings, good guidance, EPS beating Wall Street estimates. Even though their fiscal year 2024 sales fell about 3%, things are turning around. Stock had been going sideways for well over a year, however it's just broken out. Multi-year highs today, huge volume up 15%. And just moving on to a story you may have heard about in the news, and being an independent financial journalist myself, I thought it would be interesting to cover and share my thoughts with you on this one. Julian Assange, for those of you who don't know, he created WikiLeaks back in 2006, in which he would share sensitive government documents and files that were anonymously handed to him, landed him in hot water, a lot of governments, especially America, as he exposed a lot of war crimes, corrupt dealings, lies told to the public, etc. Been locked away the last 14 years, facing extradition, managed to just escape it. And so it's interesting the timing, he's just been released now. Now back in Australia, his homeland, a free man, just having done a deal in which he did have to plead guilty And there's a few interesting things I've discovered about this that I wanted to share with you guys, and hopefully I don't get censored for saying this. But if I ever do, you can always watch the Daily Market Review on X, formerly twitter.com, widely considered now the biggest protector of free speech. I post the Daily Market Review on there every day. And if you can't find it on X, you can always come directly to my website, clickcapital.io, where the Daily Market Review is posted as well. And being my own website with a .io domain, that's the top level domain coming out of the British Indian Ocean Territory, I always have control over the content on my own domain and website. And so it looks like Jack Dorsey, who was the creator and founder of Twitter, with him potentially being the person who financed his flight home from London, as he did post a cryptic tweet saying safe passage through around the same time that Bitcoin was sent to Julian to pay for it. What else you won't see reported in the mainstream media is WikiLeaks. The company he founded and distributed all these sensitive government documents just deleted over 20,000 leaked Democratic National Committee emails, no longer found on the WikiLeaks website. And apparently Trump was planning to come out and do this if he got back in office early next year, in which case the DNC emails probably wouldn't have been deleted. So just like crypto, could be the current administration trying to get ahead of Trump on this. And Julian Assange is actually lucky to be alive, because like WikiLeaks themselves reported back in 2016, apparently Hillary Clinton was inquiring about droning him, getting him taken out from the sky, in which she didn't get lucky this time, unlike a lot of other people surrounding them. And so up next could be Edward Snowden, similar setup to Julian Assange. Exposed illegal spying from the NSA on American citizen. He's hiding out in Russia. Maybe Trump does a deal to pardon him. And so I know this is all controversial stuff. Julian Assange, when it first came out, I thought he was crazy, releasing sensitive US government documents. Definite national security risk. However, over time, after thinking about it, he did expose some illegal crimes. The killing of innocent citizens in a lot of countries around the world. I think may have helped to change the culture, at least within the military, maybe keep the government a bit more honest and on their toes. And it looks like he's kind of prevailed in the end, even though he had to admit guilt and delete all those DNC emails. Maybe that's just another way of him showing what it takes to be a free man. And so even though myself, I probably wouldn't do what he's done, I do think he may have achieved something as controversial as it is. Anyway, as always, that's just my opinion and thoughts. You don't have to agree with all that. And as always, you're welcome to share your thoughts on this. There's the economic calendar for today. That new home sales coming in a lot weaker than expected. Gas and oil stocks coming in better than expected. Didn't really knock over the oil market too much though. Tomorrow we'll get a look at GDP growth rate for the States, a bit more housing data, and then on Friday, that inflation data, along with the Michigan Consumer Sentiment Survey. Fed Fund futures, still about 2/3 chance we're going to cut in September. Fear and greed index, seemingly stuck in the fear zone here at 41, and corporate insiders going into that low summer trading and buyback blackout period. Not much to report there. Okay guys, that's a wrap for today. Here we are just grinding sideways, low volatility going into PCE on Friday. Got gold and the bond market doing the same thing. Mega cap tech still leading the way. Small caps, value stocks, market breadth still under a bit of pressure. And for the here and now, the short, medium and long-term trends are still all up. Thanks very much for tuning in to the Daily Market Review. Appreciate all your support, and I'll see you again tomorrow night. Cheers.